an investor can come and go, but like if you understand that your profile is a fund manager, like I think you are signing up for a different sort of commitment, really trying to get to the bottom of like how a GP thinks about running a fund and running a firm and thinking about team scaling and, you know, being very proactive about that. Like actually hearing somebody like talk about the operational like business side of it, I think sets a pretty good framework in my head for like, okay, this group of individuals or individual are actually serious about this.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Lighting setup. Like that. Move the finger down. Hey Superclusters fans. This is the better looking version of myself, or what I could find with what limited supplies I have. But we're going to get into the weeds in this episode with my man, Nicky Sugarman. And all of this will make sense in the next 5 minutes or so. But we talk about a bunch of things. Why LPs count in internal rates of return, why venture becoming private equity is inevitable, how much COOs at venture funds get paid, and the reason you clicked on this episode in the first place, why mega cap funds are a necessary part of this asset class. Everything Nicky knows about where the venture market is going within the time it takes you to pick up your kids and back. Nicky was a partner at Stanhope, a $40 billion multifamily office running the private equity and venture practices, and is now the highly sought-after advisor to both family offices and venture investors. Moreover, he, along with Jonathan Hollis at Mountside Ventures, launched a program for the emerging manager to learn the institutional lens. The anticipation has been marinating. The veggies have been fermenting. This is an episode that has been a long time in the making. Without further ado, my man, Nicky.
Thank you very much for having me.
We're definitely going to talk about venture. We're going to talk about allocating to it. We're probably also going to talk about like what we talked about in the pre-chat, which is the misunderstanding a lot of LPs have. But before we get into that, there's something I stumbled across that I'd like some clarity on. And you can call me out on my BS if this is not nearly as relevant. But I'd love to hear about your fascination with Legos.
It's amazing. Like I think it's probably like the best. I mean, I'll say toy, but at this point, like it's, I guess in the sort of Lego that I'm interested in, like people of my age bracket, I don't know if toy is the right word anymore, but it's the most incredible product. So like I've built a hell of a lot of Lego, and it mostly centers around actually like a topic we discussed previously, like on the pre-chat, which is cars. Like I've built most of like the Lego cars that you can.
Really? Even like the newer ones, because they have some F1 cars in the recent releases.
I haven't done the new F1s, but like all the like major Lego Technic, like the big cars, I've done. Like there's been a couple Porsches, the LaFerrari, McLaren P1, Defender, Bugatti. Pretty much all of them are now done and built and somewhere upstairs.
Where do you showcase them?
So at the moment, they're mainly all either wrapped in bubble wrap or in boxes upstairs in storage. And that is because when we moved house recently, we sort of packed it all up. I just haven't like got it out and put it out somewhere yet. I'm thinking about like actually putting it in my son's bedroom, like mounting on his walls. But I have a feeling all he's going to want to do is play with it, and he's 4, and I'm not sure that's a good combination at this point.
Can you hang it high enough where it'd be out of reach?
It would be out of reach from his hands, but he could definitely throw a football at it, and that's my other concern.
Okay. That's
so fair. Yeah, I don't know. That's a work in progress in terms of where I put all that stuff.
I mean, honestly, I don't know the origin of the picture behind you, but I feel like you can hang at least one of those cars behind you. I've seen those like Instagram like accounts where they have a picture frame and then it's beautiful, right? And then you just hang the car on the picture frame, and there's like some side details as well.
Yeah, it's cool. My brother, who also does the same thing, he has some of those up. And yeah, I would like to. I just haven't got around to it yet. But it's incredibly therapeutic. If you haven't built anything in Lego in a while, I would strongly recommend buying like a good set and sitting down and having a good build, because it's good fun and it's very therapeutic.
What's a good starter set? Let's say for an adult.
anything that like is actually interesting to you in terms of what the end product is. So like for me, that was cars, but like obviously there's various sort of, monuments from around the world, football stadiums, characters or sets from famous programs, like whatever actually like you have a genuine interest in seeing the finished article of, I would pick that.
Did your fascination with cars come first, or did your fascination with Lego come first?
Oh, cars, 100%. Yeah.
Why cars? Like, was it something in the family? Like you mentioned, your brother was also really into cars as well.
My dad, I guess like he's that's always been his like number one interest and passion. So I was indoctrinated in that since the day I was born, and I guess luckily it stuck from him. But that's it. So literally from as early as I remember, that's always been like the guiding light.
Was there anything else that your dad may have imparted on you and your brother that you still carry till today? Let's say something that was really formative in the early days.
I guess like a solid work ethic. He had his own business for years, and so maybe like watching that and seeing sort of how that plays out and sort of the ups and downs, all that sort of stuff. I think that probably instills something in you. So yeah,
I want to talk about the Fund Accelerator program you're part of. It's a topic that always circles the drain every single time we have our monthly catch-ups. And so you and another mutual friend of ours, Jonathan Hollis at Mountside, recently launched this Fund Accelerator program in Europe. And the truth is there are so many programs for first-time fund managers out there. Many, not all, who have been on this program already. In your humble opinion, why do you think the world needs another emerging manager program?
But I think, firstly, it was European focused, which nobody's really doing. There isn't really a singular group who was producing something like that in Europe. And so there definitely was a bit of a need for that. I think, also Europe gets a bit of a bad name at times. And I think depending on sort of what you read on X, there's plenty of people who can sort of put down on Europe and European venture. And so I think there's some aspect of community building and sort of waving the flag, which I think was important. And I think was a proponent of one of the things that we did in the course. But we wanted to have a little bit of a different approach. So we didn't charge the funds anything. So the funds didn't pay to be a part of it. Equally, like we don't take anything from them. They don't get a commitment. That there's nothing like that. We don't have a fund attached to it. And we had over 530 funds apply for the first cohort, of which we ultimately worked with 20. So I think realistically, of that 530, and as I didn't go through every deck, you can probably assume that there's a decent chunk in there that probably were in their current status, and based on the information they provided, not investable, whether it be the team's experience, they've never invested before. It's the first time they're investing and they're going to try and do it on someone else's dime. That doesn't really fly in today's market. Well, it shouldn't fly in any market, but it doesn't fly in today's market. And so, yeah, I think that there's definitely a pathway for, future versions of that cohort over time.
And so how did you structure the curriculum? Like, why was it spaced out? And like, I'm not going to, bury the lead here. I'm going to let you kind of like spoil everything, but like, what was the cadence for those who are unaware of it? Why did you decide that cadence? And we'll go on the follow-up questions later.
Yeah, so it was basically every other week, which we thought was a decent enough spread so that like the people who were flying in from internationally weren't here like every week. And so, they could also manage that. It was sort of enough lead time so they could plan things. And also just to sort of spread it out over time. So I think the sort of why it was sort of 8 weeks, or I think 10 weeks, or however many weeks it ended up being, given that we had some back-to-backs. I think that was more just logistics than anything else. But really the content, I think it sort of came back from like, what's the question we're trying to answer? It's like, how do you help emerging fund managers understand what best practice looks like on the non-investment side of running an investment business? So the idea is like you assume, and once they get to that point, everyone on that fund program knows how to invest. And we are not there to tell them anything about investing. But, when it comes to how do you find LPs, how do you take them through a diligence process? What should you think about sort of the cadence of interacting with them and, seeing them on or off cycle, reporting and monitoring and co-investments and governance and structuring, managing fund finances versus GP finances, like all these sorts of topics, which, I think, the way Jonathan and I spoke about it is what are LPs going to poke and prod a manager on during a diligence process, or what are they going to be thinking about? And so therefore, how should a GP sort of set themselves up to optimize for the best solution there? And that was kind of the approach that we took everything from.
What are some of the most common things that LPs ask GPs, yet GPs don't often expect that question to come their way?
A lot of them haven't necessarily done the homework on like what's being a fund manager means.
What is being a fund manager?
It's running a fund business. Like, I think a lot of people just automatically assume that like if you're a VC, you just invest, but it's a hell of a lot more than that. Like, you have to, run a fund, do the accounting, and like obviously you have outsourced providers who do a lot of this for you, but at the end of the day, it all comes back to you to like approve, to make everything correct, writing quarterly reports, making sure capital account statements gets out, making sure that your investors tax reporting, making sure that your valuations are correct, all these sorts of things that are quite frankly boring, monotonous, tedious, unglamorous, like not sexy. They are the sorts of things that like can make or break whether a fund is good or not. Because you can be a great investor, but if the experience of the investor if the experience of the LP, is awful, it doesn't matter how good your fund is. Like, ultimately, somebody's got to deal with you, and like they probably got people to report to themselves. And if you're giving them a headache because you can't do the aspects of it, then that's where you're going to lose LP appetite. And so I think that's actually one thing which, like, I personally spend quite a lot of time talking to GPs about, like when I'm sort of going through diligence with them, is really leaning into that side of things and getting an understanding for like how they've thought about setting all these things up, how they think about, time management, how they think about, the deadlines and the cadence of these things. Because I think that tells, that can tell apart who sees themselves as an investor and who sees themselves as a fund manager.
And what have been some of the most thoughtful responses in this regard when you do ask about, let's say, the operation side of things?
It's the people who have been like really open about the fact that like they've leaned on friends with experience. Because like ultimately, like, the only way you sort of know this thing is through experience. And by the very nature of being an emerging fund manager, they do not have the experience of doing this before. Like, maybe they were at a big mega cap fund or a large group, and so they had a team who did it. So maybe they saw it from a distance. But I think like the best answer for like when you ask the GP or start probing them is for them to be like super honest and be like, these are the people that I've leaned on to like help me understand what best practice looks like. And so that, they're not just going in blind or going in from whatever Chat GPT says or whatever they read online, but like they're going to like experience pros in the industry to like understand what they need to be doing at certain points in time.
I imagine that, let's say, advisor group is a combination of experienced GPs who've raised their own funds. It's a combination of lawyers. It's a combination of fund accountants, fund admin folks. Are there any other archetypes I might be missing from what could, should, would be in an ideal advisory group?
No, I think that pretty much covers it. I think the only other thing I would say that I really like hearing and seeing is, and it's obviously dependent on that individual, but when they also get the opinions of people doing the same jobs in other asset classes. So, like venture funds where they'll have sort of a private equity partner or a real estate partner or a distressed debt person like on call for them to like pick their brain on, because ultimately that's the sort of the bigger brother or sister in the industry. These are the big asset classes. Venture's this little plaything down there that people dip their toes into. Most LPs are not just venture LPs. Their venture is like the last line on their asset class schedule. So these are the expectations they have. It's like what the PE funds are doing, the real estate funds, the credit funds are doing. So actually learning from that is a great thing to carry downstream.
At what point for you would you say stalking is diligence? And at what point is diligence stalking? Like, where's the fine line there?
Is there a difference? I'm not sure. I guess if everything is within the mindset of you're doing this as part of your job and not trying to find out, what your VC's favorite VC manager's boyfriend or girlfriend is, then is there really a difference? Like, if all you're trying to do is discern the type of person and character that you're trying to give money to, like stalking and diligence are kind of exactly the same thing. There's personal boundaries you obviously don't want to cross, but other than that, I guess it's probably a very thick line.
Let me propose a definition, and you let me know if you agree or not. Diligence you get paid to do. Stalking you don't.
Yes, in a way, but if you are, even if it's like off cycle when a manager's not actively fundraising, but you're doing your, we'll call it research, but it's stalking online. You're still building like the mental model of who that person is, what their network is, what they do, the types of things that interest them. So even if it's not like, the final aspect of diligence, which is like, getting ready to tickle the boxes and all that sort of good stuff, still diligence. Like, it's still trying to understand, is this somebody I trust with mine or my counterpart's money?
Are there profiles and or platforms that you think are off limits for diligence? Like, is a Facebook profile too personal?
I wouldn't go on someone like, I would never go on, I wouldn't search on Facebook. Okay. I don't think I would do Instagram.
Okay.
I have come across people on Instagram where, like, if there is somebody that I follow who's in the industry or like is a friend, and like, you end up clicking through and through and through, and then you do get to somebody and then inevitably they have like no followers, which I always find quite weird. But
I might be one of them, by the way.
I'm not going to call out any names here. But X, LinkedIn, sort of all your usual places. I'm a big X user, but I don't know what the word is now, but tweet. I never zeet or whatever people want to describe it as. But
Let's just say tweet. I think tweet.
But that remains. But it's probably my number one most used app on my phone. Like, if I was to go into my screen time, because it's basically like the way I use it is it's like a curated news feed for me. Yeah. So I follow like all the accounts that I want to see information out of, whether it be organizations or people or, cultural topics and things like that. And I get basically a curated live newspaper every second of the day.
I do want to touch on something that not only did we mention in our pre-chat, but you also mentioned about mega cap funds. And so if it's okay with you, I'd love to pivot into that, why would you say mega cap funds are necessary?
I think two things. Like, ultimately, you look at the size of the rounds that some of these companies are raising. That money has to come from somewhere. And I think probably there's probably another much deeper, longer discussion to say to any of these companies need to be raising that much money. But, and sort of what does that look like in today's environment? But ultimately, if they do want to raise such large sums of capital, it does have to come from somewhere. And like, even if you think about like a 50 million round, a 50 million check is huge. That's bigger than most funds. The long tail of venture funds, which is like kind of where everyone sits, most of them probably aren't that big. And if you think about like the diversification required to sort of produce a funds, the capital that you lose on fees and expenses to write a $50 million check, the fund size has to be billions.
Yeah.
So firstly, I think it's like a necessity of the market, but then, and maybe the incentives here are the wrong way around, but like ultimately it's also where the biggest investors need to actually park their capital to get venture exposure. Because, if you look at a big US public pension plan, they can't invest in emerging managers on the whole, just because they have a minimum ticket size. They can't be more than X% of the funds. They're never going to do anything below that because it's not really in their interest. And so if they want venture exposure, they need to write 100 million ticket for one at a time. And they might need to write 3 of them a year. If you're a CalSTRS or CalPERS and you need to, your venture bucket is a couple hundred to $500 million per year. And it might be more than that. I don't know what the latest numbers are. Where do you put that? It can only go so many places. And I think sort of a lot of people disregard those types of commitments of like, it's not venture, but actually like, if you think about it from their side of the table, what are they solving for? They basically just want, if venture is like the riskiest asset class, which I think most of us would probably say it is, like they just want the highest return of the asset classes they're investing in. Well, like if you go down like the risk return curve, the one before it is probably private equity. and which is like pretty risky, and like returns are, top quartile returns for, mid to large market private equity, which is again when most of these investors get their exposure through, is probably like a mid-teen IRR, mid to high teens, depending on vintage. So, think about it in venture land. All they actually need to do is do like a high teens to low 20% IRR, but given the time horizon involved, the multiple that you get to from that, if it's a mid 2 point something X net return, that's better than what they're getting in private equity. It's going to be better than their benchmarks. So that's additive to their portfolio. So like the only way they're getting venture exposure is in these sorts of funds. And again, maybe again, as I mentioned, like the incentives there are the wrong way around, but it works. It doesn't have to work for everyone, but it does work. So that's where you see, Andreessen potentially raising 20 billion for their latest fund. I mean, another discussion is to have is sort of some of these funds moving into the private equity space, which I think is an inevitable trend. But, they have the ability to do it. And, from their side, why wouldn't they? The fees on it is huge. And the carry on it's huge. The carry on 20 billion, even if you 2x the funds, it's bloody enormous.
Oh, yeah.
It's worth it from their perspective. I think, let's not forget everyone here is a capitalist at the end of the day.
Why do you say that venture moving into private equity is inevitable? Is it purely on fees, carry, but are there other reasons as to why that movement is inevitable?
I think fees and carry are one of them. I think it's also, the incentives of the GP in terms of scaling both of those. There's only so much you can scale in venture before the return dwindles, and I think we're seeing that. So what do? You sell a different product. You sell buyouts. And to be honest, I think the other reason it makes sense is, and there are some fantastic tech buyout funds out there, and software funds and things like that. Even more generalist groups who have software practices who have done fantastic deals over the years. But, if actually what you're underwriting when you underwrite these managers is their network and their ability to win companies, one of the reasons why so many venture funds are led by experienced and highly successful founders is because other founders have the appeal of working with them. You don't really see how many private equity funds are run by exited founders. It's probably a handful, if so, whereas the big venture funds, it's probably the inverse. So actually they have a pretty interesting network that they could tap into and a pretty unique angle to try and win some of these deals. And so it's natural that they would want to gravitate towards that part of the market.
A private equity portfolio usually has 10 to 15 companies, in terms of a concentrated side of things. And then venture concentrated means less than 20, less than 25, give or take. And so obviously the portfolio sizes are different. And as we talk about, and a lot of these firms have become more asset management firms than purely just venture and private equity.
Yeah.
But do you find portfolio sizes, check sizes, ownership targets will all differ as these venture folks move into private equity?
Yeah, I think it will. And, I think the check size is going to go up dramatically. Deal dynamics, we're going to start seeing leverage within sort of the VC portfolios, which obviously we never really did before, but in PE, that's table stakes. The ownership percentages should probably skyrocket compared to, where we're used to seeing. So it'll probably be the inverse of what we're used to seeing, to be honest, which is kind of where private equity is. And I wouldn't be surprised if the way that we get there is, Andreessen partnering with Vista on a deal, or with Thoma Bravo or something like that. That will be the entry point, where it will be groups partnering with experienced private equity shops, whether it doesn't have to be 50-50, but that'll be their in. And, we'll see a number of those. And then somebody's going to say, we're going to do it ourselves. And they'll hire the team from pick your leading software fund and say, come and build this with us. And they will probably be able to have their pick of the talent.
I've heard previously that from LP friends where LPs like to be the folks who are diversifying their own portfolio, like to be the diversification strategy. They don't need an asset manager to play diversification for them. As these funds are moving into PE territory, they're and wealth management firms and all that, they are by definition just moving it across territories and taking over large chunks of other territories as well. what do you think LP appetite, or like what are the ideal kinds of LPs for such an institution?
Well, I think it just opens up like a bigger universe of LPs. I think, it's again, like I hate to pick on Andreessen, it's an incredible firm, but like if you think about sort of their LPs when they started, compared to like if they do raise 20 billion for their next fund, like the available pool of LPs they could tap into, irrespective of like their brand name and their track record and their performance, the available pool of LPs who will go into a $20 billion fund versus, don't know how big their first fund was, but smaller than that. It's just like
100.
It's the number of LPs that are of relevance to them is like exponentially bigger. And then, it's a different competition, when you're trying to win, you're trying to win over an LP's interest. If the LP is, looking at, call it generic buyout fund XYZ, who do a number of different deals, but maybe software and tech is 30-40% of the portfolio. And then, here is highly experienced venture capital fund manager that has scaled over time. Their returns have been incredible, albeit different types of deals, moving up into a new spectrum, differentiated insight, differentiated access, and differentiated sort of selling point compared to the other funds in their portfolio. It's a pretty attractive proposition. You've got to be willing to take that risk. But if you're picking between, do I go Vista, Thoma Bravo, Silver Lake, or do I go, Vista, Thoma Bravo, Andreessen buyout fund, or whatever it is, it's probably going to be slight differentiated exposure and a differentiated proposition. And the number of LPs who can write big enough checks into a fund like that is just exponentially bigger. Why do
you speak in IRR? Why not TVPI? Why not DPI? Why not MOIC?
I prefer to speak in multiple because like that's actually what you're saying. What's the quote? You can't eat IRR. Yeah. If you actually like look on the LP side of things, a lot of LPs are paid on IRR. So particularly like some of the big pension funds and institutions like that, where, private equity or venture is like one part of a broader asset class or one part of a broader portfolio, sorry. And, most other asset classes, as we know, are measured on a percentage basis rather than like on a multiple basis. And so, compensation tends to be tied to that. So I think we spoke about it before, but there's a fantastic account on X, Endowment Eddie, who, has a lot of great content. And he put out, one of the things the other day, which is like, comparing the different marks that different funds hold their portfolio companies at. And, often if they're holding the same company, they might have different valuations and groups not necessarily bringing valuations down. And one of the things he said is that, remember, a lot of LPs are paid on IRR. So keep your valuations high because, ultimately that's what they're getting paid for. And I think that's true. Multiple from my perspective is much more important because I am more intrigued to like see how much money is actually being made. But the bigger investors in the asset class on the whole talk in IRR terms.
Gotcha. And it's largely because the other asset classes they're investing in are largely IRR based.
Yeah, or if it's not IRR, it's like percentage-based return metrics.
Most don't even get in the territory of multiples in the first place. I think there are a couple black swan moments where we just see like people appreciate, like not people, but firms or companies appreciating more than 100%. But it's very, very, very rare that any firm appreciates more than 100% within a 12-month window.
Yeah, and never downwards. It's never going to be greater than 100 downwards. So like it's always, you're never going to see anything greater on that side of things either. And so, all of that's always measured on percentage basis, which is kind of where, the bigger, broader asset bases are. So, inevitably that's where the language in this world comes down to a lot. But yeah, I'm much more of a multiple person.
Well, what are your thoughts on going back to what Endowment Eddie posted, right? I actually haven't seen that tweet yet, but I got to go find it. And I'll link it after as well. What are your thoughts on funds holding different valuations? Does that send you, like, what are the questions you ask? What kind of signals does that send you if someone's holding a certain company at a higher valuation than another fund that you're already investing into?
I'll always ask the question, especially like, I'll always dig into it if it's a fund that I am diligencing. So like if it's a fund I'm diligencing, they're holding at an unrealistic valuation. And I guess one of the ways I often check this is like, you only do it on like the couple big winners in the portfolio. It's like actually look on the secondary market and see where things are trading. But I would always question that. And quite often it comes down to the fact that like their investment policy or their valuation policy is its last round for X many months. And then it's only when you go outside of that range. And yeah, there can be differences, like if they're holding different share classes, where they sit in the pref stack and stuff like that. And listen, if it's within a couple basis points or like a couple percentage points of, difference, I'm not going to sort of be too dramatic about it. But it's when those differences start sort of expanding, that's when I want to know. Inevitably, it comes down to the fact that one GP doesn't have the same information as the other. And, one is probably closer than the other, which is why they've inevitably going to be valuing it downwards. I see it more on that side than, one increasing it and the other not.
I mean, there are some GPs that have information rights. There are some GPs that just don't have information rights. And sometimes we just don't know the revenue numbers or health of the company. It's just harder to build a more concrete analysis on it, other than just purely how much the valuation has gone up, how much has my stock price gone up.
Yeah, exactly. And so that's why, like, sometimes it can be sort of forgivable or excusable. But, if there's considerable differences, or like if one puts in some pretty dramatic changes in valuation, the other hasn't, to be honest, it can actually be useful to the other GP to be like, listen, by the way, you might want to do some research here.
What is unreasonable? What's an example of unreasonable?
It's probably, I don't know, maybe double-digit percentages.
Okay.
Yeah, maybe at that point you're starting to sort of question it a little bit.
So anything north of 10%?
Maybe, yeah. I don't know what the exact demarcation point is, but maybe it's 10, 15%, once you get outside of that range.
I mean, that makes sense. I mean, when it starts sending kind of certain alarm bells in your in your mind, and these are like soft. It could be like 9.5. It could be 11.5. But yes.
Yeah.
It just has like a rough reference point for folks who are like, oh, is like 5% a lot? Is 30% a lot? Obviously, 30% is a lot.
Yeah. Yeah. That is a lot. I think 5, again, the other thing is like, how has it moved? Has one taken it off of last round valuation and just adjusted it by 5%? In which case maybe they've taken the approach like, oh, public markets have moved by this percent, so we've adjusted by this percent. In which case, like that's fine. It's when there's like larger significant changes, and when there's added commentary to say, we have adjusted the valuation because of trading challenges or things we're seeing. So yeah.
And how often does that come in reporting? Do GPs often call it out in their, let's say, quarterly reports, or for some it's annual reports, like, hey, we've changed this, here's an asterisk here, do note that?
No, most don't.
Okay.
I would say that the established players are pretty poor on this. I think the more emerging funds, like the good ones, are actually being really thoughtful around this in terms of how they communicate with their LPs and sort of what they share. If I've seen plenty of quarterly reports and capital account statements from, pick your big brand name sort of large funds, and the reporting is atrocious, awful. There's just no information in it. And it's very unhelpful. So yeah.
Oh, that's fascinating. And do you follow up as an LP? Do you often follow up if you've heard wind of something? You're like, hey, know what? Okay.
Yeah, definitely.
And does that happen often? Or
no?
Because you're covering so many different asset classes at the same time. You're not hearing everything all the time.
Exactly. And it's, if there was something that consequential, the chances of you hearing it before the manager has obviously made any changes they need to because of that information is rare. But I've definitely asked GPs about things I have heard in the market before. It's ultimately it's our money, and then it's not even my money, but we are stewards of that capital, so it's our money, so we should know what is happening with it.
So rule of thumb, hear the news from your GPs first, not from whatever news outlet you watch.
Yeah. If you're seeing it in the news first, that's a bad sign.
There are probably black swan events every so often. For example, the banking crisis that happened like 2 years back, that just it hit front page news so fast.
Yeah.
That the GPs didn't even have time to communicate with everyone.
No, you're right. And then I think the interesting thing there is like how quickly different groups then communicated to their LPs in terms of what exposure they had. So like for that exact for that exact instance, it's like, the funds were going and seeing from the fund level, GP level, and portfolio company level, who banks with SPV or First Republic, like who had facilities with them, like who was in danger and things like that. And, there were good GPs who were like very proactive in terms of, because it basically happened on a Friday.
It happened on Friday. It happened on my last day at this company I was part of, Ondex. I remember that very distinctly.
Okay, so you will never forget that. So yeah, GP sending. We had several GPs send emails over the weekends, and like I think I had one who did a call on the Sunday, maybe. Who was like, we'll repeat this, and you can have it on the Monday, but like we want to give this to you as soon as possible. And like that's great. I think taking that approach is thoughtful, and also like, it matters a lot to LPs. Like that's a good thing for a GP to do.
Okay, I want to pivot to like emerging managers for a second. We did kind of talk about it, but one of the interesting lines that you've had in the past, which I knew I had to ask you about, was as someone who's like once said that early stage venture is an interesting opportunity for selectively partnering with groups who have the potential to weather the storm well and become the leading names of the future. I'm curious for you, how do you underwrite or how do you assess a venture manager if they have the ability to stick through hell or high water?
So we spoke about this a little bit before, but like one of the things that I really like digging into is like how focused they are on like the operational setup of their firm, like the fund manager versus investor question, because the ones who want to stick it out and actually make a real effort of it, like they understand their position as fund managers rather than just investors. Because, an investor can come and go, but like, if you understand that your profile is a fund manager, like I think you are signing up for a different sort of commitment. And so really trying to get to the bottom of like how a GP thinks about running a fund and running a firm and thinking about team scaling and, being very proactive about that sets a really good precedent. I think take it for granted that they can all sell a good story over what their strategy is and like what they're going to do and where they're going to deploy and like how amazing their network is and things like that. But like actually hearing somebody like talk about the operational like business side of it, I think sets a pretty good framework in my head for like, okay, this group of individuals or individual are actually serious about this. And then as a judge on their quality and things like that. But that is something which I really look for.
Are there other things, for example, like, do you ask them like, what is fund 2, what is fund 3, or what does like fund 4 look like kind of thing? Or
yeah, definitely. And I think that's not just a question of like size, but it's also a question of like resources. So, where, if you're a fund 1, all of a sudden fund 2 comes on, even if it's the same size, you can more or less double the revenue of your firm. Like, where does that go? Is it going into your pocket? Are you hiring somebody to do, help on the legal? You're going to hire a junior investment resource. You're going to hire a partner to lead on investments. Like, where do you think you want to scale? And like, I can think of some really good GPs who have been really open about that, even as they raise their first funds. And have been very like had really open discussions with their LPs of like, this is my intentions over what I want to do with this organization over, 2-3 years, 2-3 vintages and things like that. And obviously like you can't hold them to it and it could just be lip service, but the thinking that goes behind that is really important.
Have there been ways or examples of how people have explained their future funds, that whether they followed through with it or not, that you personally really liked?
It's a good question. I think the ones that I remember are the ones that like stick out to me are the ones that have like been very thoughtful about it. Like already have like a candidate list of like, these are the people that would fill these roles. And like, they don't share names because obviously that's a tricky situation, but like, this is the profile and like, these are the people that I want to fill these roles. And, it's funny, like there are some groups that then 2 years later will be like, this is the person. And like, they'll be like, yeah, this is the note I wrote 2 years back where I first had this idea. And, those are the ones that stick out, like the ones who really had thought about it, like ask LPs in terms of like how they view firms building out like the business operations, like the team, where they should be adding, whether it's sort of, back office or like investment side of things. Like when there's a very open with LPs and like getting feedback from them. Those situations stick out more than anything else.
Do you have a personal preference on who the first few hires should be at a firm, like outside of the like GP and maybe like the associate, right? Like, are there other folks that you think should be critical hires in the first few years?
I would say like they should always optimize for like hiring the investment staff to begin with. I think as long as once they get to the point that sort of the investment business is running, and knowing like what comes with that is knowing that that team are responsible for all the other aspects. Like that team are the fund managers. Like that is as part of a job as investing. I think the next job is the next like key hire is probably I don't know whether it's operations or COO or something like that, but it's the person who can basically run like the operating system of the fund, like the person who is the day-to-day contact of the administrator, of the accountant, of the lawyers, of who can help on reporting and monitoring, like almost like a chief of staff type person, but they're not focused on the investing, they're focused on like running the actual funds and running the business itself.
And in your opinion, what do you think the traits of an ideal COO are?
It's firstly, I think they've got to understand the assets as well. Like I think that's important. I think they have to understand the markets they're operating in. But that is, those sort of roles that a COO or somebody is focusing on are not sort of the areas, and I'm talking about this like from a fund management perspective, are not areas where you're reinventing the wheel. You're not trying to come up with anything that's too unique or do something from scratch for the first time. So actually like steady pair of hands, somebody that comes from, another shop that's probably been incredibly well trained, and has a good background from that side of things, that gives a lot of LPs a lot of comfort. And so that's kind of the profile which I think works for that type of role. As I said, it's not reinventing the wheel, that sort of stuff. So you kind of just want somebody who knows what to do.
How much do you think a good COO should get paid?
I think the issue is that like in emerging managers, there's just like, and I mean, to be honest, by the time you're hiring a COO, like you're probably emerging into emerged, but like there probably just like isn't a huge amount of capital to go around. So, and also I think it depends what geography you're in. But somewhere in the low 6-digit probably range, depending on what city you're in. Like, I guess if you're in, very experienced, if you're in sort of your neck of the woods, I'm in London, obviously, but in your neck of the woods, maybe it's sort of pushing up a little bit more than that, but something in that range. I don't know.
Okay. I mean, there's no right answer. And sometimes if you bring in a COO at fund 2 and you're just still figuring things out, you're like 3 years into the fund, you obviously don't have that many management fees to like push around. But let's say you're in a fund 5 and you've scaled past like 500 mil AUM kind of thing.
Yeah. Then it's makes sense. Yeah. And you can afford it. At that point, you can afford it. Yeah.
Do you think people should get paid? And I'm asking all these like rookie questions, so feel free to stop me here. But do you think people should get paid at the 50th percentile, or do you think people should get paid north or south of it?
As in like comparable job, like what other roles are paying, or is that like performance of the funds? Like, should you get paid if like performance is 50th percentile?
Let's take job title first, and then let's do performance second.
I think you should get paid what your experience and sort of, your experience, your track record, your history commands. Like ultimately, the only time you really get to actually negotiate your pay like properly is when you move jobs. So I'm a big proponent that everyone should like negotiate super hard on the entry because it's the only chance you're going to get. And I think a good organization probably should value the people they hire. So the only reason you have 50th percentile is because somebody's going to be the first percentile. So I think people should get paid what they deserve.
I won't name the fund manager, but there's an interesting fund manager that once said, I believe in pay, and they've grown quite a bit in AUM, by the way, but I believe in paying like my staff like 4 or 5x market rate, which I always found to be really interesting. And the rationale behind that was if someone is going to leave the team, it's not because of money. And that means I must have done something really shitty, or the team must have done something really shitty, or for whatever reason that limited their potential for anything else, right? And I thought that was really interesting framing. Although I don't think a lot of LPs would be happy to know that every team member is getting paid 5x market rate.
That sounds quite excessive. But I understand like the biggest worry that probably most people have in their lives, apart from like their health, is probably like their financial security. So effectively, they're basically saying, "I'm going to take that question entirely out of your hands." So I don't know. I'd actually love to know, like from a psychological perspective, how that actually worked out for them.
Well, they've, as far as I know, I won't mention the fund. We can talk about this offline and all that. But it seems like they have very little churn so far.
Yeah.
They've been a couple years in the business. They started right before the pandemic. I would like so far.
That's an interesting social experiment.
Yeah, I honestly have no idea. Question for you. Actually, this is a conversation I had with a lot of GPs, emerging GPs fairly recently. Promised my last question, hard hitting, or just like venture question here. But how much should like a fund 1 GP pay themselves versus a fund 2 versus a fund 3 versus a fund 4? And we can talk about this as a function of AUM as well. But a lot of emerging GPs are really hesitant on paying themselves a lot of money because they want to be scrappy.
So I believe they should pay themselves the maximum that they feasibly can, that the fund operations don't suffer, and that they can afford to live. Because like going back to that last point, like you don't really want to invest in a manager who is like can't afford to get by. And you don't want them. They'll make different decisions if they are living paycheck to paycheck than if they were getting paid 5 times their salary. I'm not sure which one's better, but there's probably a happy medium in the middle. So I don't know what like the definitive number is, but it's more, what are their living expenses? What covers that plus a buffer? Gives them that security. Like where do they feel comfortable in that spectrum? And like also whatever the capital they have behind them, like they're an exited founder for, however much. Do they need a salary? Like, I think that's a different question. And like, is that capital like that meaningful to them? Probably not. Whereas like the person who scrapped and saved like everything they possibly can to like start this new venture, they should get paid something to, give them some security.
What is that buffer in your mind? Is it like a 10% buffer, 20% buffer? Like,
I don't know. I think it depends like what your lifestyle's like any dependence you have. Like, for example, I'm married, got 2 kids. So like between my wife and I, like our buffer is very different than somebody who's single with no kids. Right. Like if God forbid something happened to both of our jobs at the same time, we have to make sure that we're covered for like our children. There are certain costs that like we just can't get rid of. So I think the buffer more has to solve for like each individual circumstance rather than anything else. I
remember part of the reason I bring this up is there's a conversation I had about 2-3 weeks back or something where there was a fund 4 GP who is paying herself $80K a year, which is the equivalent of like 90 pounds, give or take, right? And I was like, you're fund 4, you've passed the 100 mil AUM threshold. And she's like, I don't feel good about paying myself this much money. I need to do right by my LPs. And as far as I know, I don't think she comes from wealth either. She wasn't like a massively exited founder. And I always felt that to be a little bit too little in my mind. She was living in the Bay Area, by the way, as well.
She wouldn't be paying herself 80 if she couldn't get by on 80.
Okay.
Like ultimately the money just runs out. So she must be able to get by on 80. I mean, by the time that she's on fund 4, so that AUM base, she can probably afford to pay herself a little bit more. But ultimately, like if she's not spending the money elsewhere from her organization perspective, the money's still in the GP's account. So like she might not be paying it to herself, but it's sitting there in case she needs it.
Out of curiosity, what's the one what if that keeps you up at night these days?
Answering it like focusing on this market, like I guess it does. I'm bored. Like none of these questions keep me up on that. Like I think we're all. I speak personally. Like very fortunate I do something that I love and like I find super interesting. But the most important things are like help family and friends and all that sort of stuff. So like I don't find these sort of things keep me up at night. But like the question that I do think about quite a bit is like, as it relates to like venture, like what does venture look like going forward? And like, has this basically have played this out to sort of where it's going to go? And like, is the next iteration this move upstream into private equity and things like that, which I definitely think is one part of it. I think there's, you read loads of people talking about what's going to be the first $1 billion single person company? How much capital does a business like that need to scale? And you look at like the Cursor figures and like the growth they're having. It's just unbelievable. What does this industry look like in a world where these sorts of things exist? The increasing number of founders who are operating to raise as little capital as possible to go profitable as quickly they can, grow slower, but retain control and sort of be profitable. All these sort of trends happening at the same time, like where does that leave venture over its next cycle? So that's something I think about quite a bit. It doesn't keep me up at night, but it is something I think about.
Oh, this is fascinating. I actually had a conversation last night at a dinner with a friend of mine about this. Shout out, first of all, to Henry Shih, who co-founder of Super, took a step back fairly recently, now focusing a lot of his time on new projects. But one of the projects in which he has is this project called the Lean AI Leaderboard. So if you just search up leanaileaderboard.com, I believe that's just like that website, which is effectively he's tracking and he's ranking people on a leaderboard by revenue per employee. And I think current first place right now is Telegram, sitting at $1 billion in revenue at 30 employees.
Unbelievable.
And well, I mean, there's an argument of like, is it 30, is it 29? But we'll leave the political commentary aside for now. That said, like I think Cursor is also on there, and there are a bunch of folks on this
50 people, I think, at Cursor. Is that right?
I think so.
I
want to. You know what? People can fact check us, but we'll also put in the show notes of like Lean AI Leaderboard. Things may change by the time this episode comes out as well. All that to say, I agree with you. I do wonder a lot on founders raising a little bit of money. There's this new term called like seed strapped, which is not bootstrap, but you raise a seed round and the goal is you never have to raise ever again. And sometimes the seed rounds are done on safe notes, so they're not priced, whatnot. And you have these note holders almost holding perpetually, and a lot of these companies wanting to stay private because there's no reason to go public. And so there's no immediate exit opportunity as well, and they're just holding these perpetual safe notes indefinitely. And so I'm really curious what that does to change the venture capital world, and where does the exit path look like from there? Is it secondaries just because after you hit a certain threshold? Is it a rev share model? Is it a dividends? I don't know.
Yeah, I agree. I think it's going to be. I think we'll see like more and more interesting sort of fund strategies pop out. I think there's a lot going on secondaries at the moment, and like these things will continue to develop and grow and become an even bigger part of the market, like they did in private equity.
It's fascinating. We'll have to do this again. Nicky, thank you so much. What is the best place for people to find you? Because I'm sure they've learned a lot. Maybe they want to apply to the Fund Accelerator program. Maybe they want to, hear more of your thoughts, whether it's LPs, GPs, you name it out there. Maybe they want to learn a little more about Legos and cars. Where do people find you?
As you spoke about before, I am a avid user of X, but I never tweet. I have a very easy to find account because it's literally just my name. You'll not find anything interesting on there in terms of my thoughts, but I'm there, or LinkedIn, which is the other place, which, I also don't really post, but you can find me.
I also want to give a shout out to Rahul Prakash, who introduced us at Nomo.
Yeah.
And I do also want to note this as well. I've told him several times that you have by far one of the coolest names I've come across, Nicky Sugarman. I was like, that's just like such a cool name. Like, I wish I had that name. So if your wife's okay with it, like I'll borrow your name at some point in the future a little bit. All that to say, Nicky, thank you so much. This has been super insightful, and we really got into like a lot of the nuance here, which is the beauty of this podcast.
Yeah, no, it's been a pleasure. Thank you so much for having me on, and it's always good speaking to you, so I appreciate it.
All right, Superclusters fans, until the next, see you soon. Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are 3 small things. 1, there's a little red subscribe button down there. If and only if you enjoyed this episode, that's the button to click, and you'll get many more presents, insights, and brilliant minds straight through the internet vines just like this one very, very soon. 2, if you could do me a favor and let me know down in the comments what your favorite Nicky lesson was, I would greatly appreciate that. 3, it'd mean a lot to me if you could share it with one other friend you think could gain a lot from listening to today's cosmos of insights. And let me know if there's anything I should have asked down in the comments. And if there's enough interest, we'll bring Nicky back. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more meaningful and helpful to you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I want to share a quick disclaimer. The views expressed in this podcast are for informational and educational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that I'm a part of, and none of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds and companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that is all from me. I'll see you on the next.